Let's start our today's revision. That will be final account preparation, AAT sample assessment 1 from the BPP. Let's start with the question number 1. So task number 1 is normally the big question that we'll see in the exam, and that will contain 15 marks, and that will be from the incomplete records. Now, obviously, I try to explain as detailed as possible. But if you have any question, please let me know so we can discuss more. Let's read this question. Task 1, 15 marks. This task is about reconstructing general ledger account. You are working on the accounting record of a sole trader for the year ended 31st March 2007. The business is VAT registered. You have the following information. So we have a day book summarized, we have a sales day book, we have a sales return day book, purchase day book, and purchase return day book. That's the goods, the VAT, that's the total. Then on the further information section, we have a general expense. Net is 7510, VAT 152, and total is 9012. On the opening and closing balance section, we can see trade receivables. We have a opening balance 17,360. Closing balance we have 18,940. Trade payable 13,345. And 31st March 2007 for the closing balance 14,656. Closing inventory, so we have opening for the closing for the 2006, that is 10,520. And we have a for the 2007 11,300. VAT we have only the closing balance for 2006, that is credit balance. We don't have a balance CD. And the bank we have opening balance 3811, that is debit. So this is our balance. Remember, all of this record we are talking about, this is our record. So looking from our point of view, from the business point of view. The next point we have, that one is general expense are not processed through the purchase day book. So general expense is not the part of purchase day book. 9012 was posted to the general expense. So 9012 was posted to the general expense. All the VAT on this expense is recoverable. So that means the VAT we have 1502, that is possible to recover, and we have to recover it. Cash sale 4,200 were made, excluding VAT 20%. The total bank was posted to the cash sales account. So this is my cash sales 4,200, and we have to calculate the VAT 20% because the VAT is excluded. All purchases are on credit. So every single purchase we do in credit. The trader took advantage of prompt discount whenever offered. VAT has been correctly accounted for. Receipt and payment record in the bank statement. Amount from the credit customer. So that means this one I received from the credit customer. So this is basically the bank that we received from the credit customer. Amount to supplier. So this is the payment to the supplier. Amount bank from cash sale. So this is the income from the cash sale. Loan receipt. Rent paid. General expense. HMRC VAT payment. Drawings and the wages. So basically this all the information we have from the bank record. So on the bank we have a two side, the paid out and the paid in. And of course, like this is just like the bank statement telling us how much you have received and how much you have paid. um Magda, you asking, can you explain why bank credit city balance was posted on the debit side of the bank account? So you mean that one, 3811? Basically, if you ask me this one, that is the balance we have on 31st of March 2006. So this is the debit balance. That means this is the money we have on the bank account. And from our point of view, this is our asset. So that's why we said 3811 is the debit. So we don't have any balance for the 31st of March. Maybe we have to calculate that, the closing balance. But this one is for our 2006, the opening balance. Okay, so there is a two-way. Obviously, the bank can say like it's overdraft, or it can say it's your record. Now we have to think from the two point of view. The first one is like, from our point of view, if the bank is debit, that means it's asset. If the bank is a credit, that means it's a liability. So we are using the overdraft. But from the bank point of view, if bank said this is a debit, that means it is a liability, it's overdraft. And if the bank said credit, that means it's an asset. So we have to find the difference, because from our side, asset is a debit. From the bank point of view, they said credit, that means this is a liability for them. They're holding our money. So if we keep the money in the bank, of course, like bank will say this is not their money, and this is a liability for them because they have to pay me back. So that's why they said credit. So whatever is credit for them is a debit for us. Whatever is the debit for them is credit for us. Now in the exam or in the question, they might give you both, so you have to follow the question. And all of us need to be careful when we read the question. Is it like on our record or it is the bank record? So if it is our record, then we have to follow the debit and credit. So debit is asset, credit is a liability. If the question said information from the bank, then the credit will be the liability. So that why on the bank account is on the opposite side. Um, yes, obviously, like on the bank account, you see always on the opposite side. That's the reason, because the bank holding our money, so bank show them as a credit, because for them it's a liability. All right, thank you, Magda. So let's have a look. So this is from the bank statement, all the information we have, receipt and payment. Now let's read the requirement. What we have, they're asking. The first question we have here: find the missing discount figure. So from the first question, we're going to find the discount figure by preparing the purchase ledger control account for the year ended 31st of March 2007. So you have to prepare the purchase ledger control account, and from this account, the balance CD, the difference will be our discount. So the question will tell you what we are looking for. So question is asking to find the discount, so you have to find the discount from here. The next point we have here, they're asking to do the VAT control account. So we have to read the question. What are we going to find from here? They said find the closing balance. So that means from this VAT control account, we're going to find the balance CD. That's simple. And finally, we have, assuming there are no year-ended adjustment, what will be the opening bank account balance in the general ledger as 1st April? So this one they're asking, once we have the opening balance, then if we look at how much we received on the bank and how much we paid from the bank, so after that, how much will be the closing balance? So if we have money left on the bank account, so that will be the debit. If there is no money left on the bank, that will be the credit. So that will be the liability. That means we are using the overdraft. All right, let's try to start from question number 1, that is purchase ledger control. We're going to do this answer on the right corner, because if we scroll down, we cannot see it. So better try to do it in the side. So purchase ledger control account. Purchase ledger control account is a supplier account, and of course we know the opening balance will be on the credit side. It's a liability account, that the money we have to pay to the supplier. So let's start with the opening balance first. Trade payable. This is the opening balance 31st of March 2006. This is the closing balance 31st March 2007. So we said our opening balance will be how much? 13,345. So balance BD 13,345. That's the opening balance. And after the opening balance, the left hand side is the debit side, right hand side is the credit side. Always, even you don't have to mention it, but we know the left hand side always the debit. So purchase ledger control is a supplier account, the money I have to pay to my supplier. So that's why the opening balance on the credit side. So the next point we have the balance, closing balance. So the closing balance we have 14,565.6. So this is the balance CD. Balance CD. The question already gave it to us. So that is 14,656. Then we have to identify what else will come here. So first we'll see how much was the credit purchase. So let's have a look. From the purchase day book, we can see that's our purchase. So how much will be the purchase? Remember, if you take the figure, you always have to consider the VAT. When I pay to the supplier, I have to pay with the VAT. And when I receive from my customer, I receive with the VAT. So they'll give you the net figure, VAT and total separately, but make sure we always consider the total. So we said the purchase that will be 149,348. So that's for the purchase. If I buy more, I have to pay more. Then I will need to see, is there any purchase return? The question said none. There is no purchase return, so I don't have to worry about it. Now we need to see, is there any money that we already paid to our supplier? So we'll go to the bank and have a look, is there any money we already paid to our supplier? Because if you already paid something, we're not going to pay it again. So we can see amount to supplier. So we paid this money to the supplier. So that is 145. So we said bank 145, 137. Now that's it. After that, all we need to do, we need to add it our side, the credit side total, and we'll minus from the debit side these two, and whatever the balance will come, the difference, that will be the discount received, because the question said find the missing discount. So we need to find the discount received, and that will be the balancing figure. So the total is 162. Okay, thank you, Sifa. 162,693, 162,693, and the discount received is 2,900. So that's all for our discount, the purchase as a control account, and we know how much is the discount. So after writing all of this, whatever is the difference, the question will tell us what it is. All right, so the next point will move. That will be our VAT control account. And from here, we're going to find the closing balance of the VAT. That means we're looking for the balance CD. Okay, so let's start with our VAT control account. VAT control account. Now the VAT control account, we need to look at the opening balance first. What is the opening balance? Because opening balance will tell us what will be our starting balance. So you can see the VAT, we have opening balance 1806 credit. So you're going to write balance BD 1806. VAT opening balance normally is a credit balance unless the quotient set is a debit balance. If the quotient mention you very clearly the VAT's opening balance is a debit side, only that time recorded on the debit side. If the quotient said credit is credit, if the quotient doesn't say anything, still it is credit. So if they said VAT opening balance 1806, you have to record on the credit side even they don't say is it debit or credit. All right, so this is number one. Then we have to record all the VAT. If something, if something that will increase your liability, if something that will increase your liability, you're recording on the credit side of the VAT control account. If you already paid some VAT, or you can claim back the VAT because you paid the VAT of purchase to the supplier, then you can record on the debit side. So increase your liability is the credit, decrease your liability on the debit side. So you can say if I make a sale, so I have to pay the VAT. The first thing, sell. If I make a sale, I have to pay the VAT. So sales 31 820. Then sales return. Now, of course, if the customer return back to you, you will not pay the VAT. So let's say if you make a sales 1000 and next day if 500 pound customer return to you, then you say I'm not going to pay VAT because the customer returned to me. So sales return will reduce the VAT liability. So I'm going to write on the sales return on the debit side. Sales return, that is 322. All right, then we have a purchase. VAT on purchase. VAT on purchase, the VAT I can claim back from HMRC because I already paid this VAT. And if I already paid this VAT, I'm going to claim it back. So we said purchase 24408. So that's my VAT on purchase. Now, the next one we have the general expense, and quotient said to me that the expense I make on the general expense, it is not included on the purchase, that is outside, and the VAT is also recoverable. So I can claim the VAT whatever I make on the general expense. So the VAT I have spent it on the general expense, I can claim it back. So that means this VAT will be possible to recover. So I said general expense 1502. Then we have to see what else we have. The next one we have the cash sale. The cash sale, they say the VAT is excluded. 4,200, 20% VAT is excluded. So can we find the figure for that? How much is the VAT on the cash sale? And doesn't matter it is a cash sale or credit sale, we have to pay the VAT anyway. So is it cash sale? Cash sale and 20% of VAT. So 20% of 4,200. So 4,200 times 20%, and that is 840. Very good, yes, sir. So 840. And what else you have? Now we need to check is there any VAT that we already paid to HMRC? So we can go to our bank and have a look. Is there any VAT already paid? So if we come down on the bank, we can see we paid VAT HMRC 6169. So we said bank 6169. And is there anything else you have? No, that's all for the VAT. So if we have all of this, then we need to find the balance CD. So all we need to do, we need to make a total. Normally the liability side will be higher, the credit side, then you minus the debit side. So the total is 34,466. Okay, 34,466. Thank you, Sifa. 34,466. And we minus all of this from there to find the balance CD. Balance CD. This is the question asking to find the balance CD, the closing balance, and that is 2065. So this is basically the VAT control account. So credit side is all the liability increase and debit side all the liability decrease, and liability minus the claim will give you the difference of balance CD. All right, so let's move on. The next one, what else they're asking from this question? The next question is asking to find the bank balance. So this question is quite easy. So they give us the receipt, how much we received during the period, and how much we paid during the period. So how much money you have left? So it's very easy question. All you need to see how much money we had on the bank at the beginning. So we can see at the beginning we had 3811. That is a debit, so we don't have to make the minus sign because this is our money. So 3811. This is the money we had on the beginning as opening balance. So we can say opening balance 3811. So you can say 3811 is our opening balance plus receipt. How much we received during this period? We received 200,448 minus payment. How much we paid during the period? 205,718. And that will tell us how much money still you have on the bank. So we have 1459. Thank you, Magda. Thank you, Sifa. And we have to find it is a debit or credit. Now, if you have a minus balance, this has to be credit. So if it is a credit, if we have our money, it will be debit. If the money I go to like overdraft, if I end up with overdraft, that will be the credit. So we'll say 1459, and this is our credit. All right, so this is the end of the question. Just take a minute and ask me if you have any question from here. All right, then move on to the next one. The next question for task 2 is for 15 marks. So this task is about incomplete records and applying ethical principle when preparing the financial statement. Show whether the following statement is true or false. Gross sales margin percentage may be calculated. So what is the formula of the gross margin? Gross profit divided sale times 100%. So the first question is this statement true or false? So the gross profit margin, how do we calculate the gross profit margin? So remember, if it is a gross profit margin, if it is a net profit margin, any formula, gross profit or net profit, any formula we have. So the easy way to do that, so gross profit will go to the top and sales is the bottom. If it is a net profit will go to the top, NP, and sales will come to the bottom. And to show or express this one as a percentage, we have to multiply by 100%. That's it. So this is the profitable ratio that you will be obviously learn more in when you do your level 4. So there is a lot of lot of ratio analysis you will have. There is a paper called Management Accounting, Budgeting, Costing, and Decision Making. So on that paper, there is the area that you'll learn ratio analysis, and that is called a financial performance indicator. So that time there is a lot of ratio you're going to learn. But for the time being, if you know what is the formula for the gross profit, that will be fine. So that is true. All right, let's move on to the next one. And the next one we have here, you are a trainee accounting technician who prepare final account for a number of sole trader client. You have the following information about a business for its year end 31st of March 2007. It is not registered for the VAT. It is not registered for the VAT. The trader operate with a gross margin 25%. So that means the profit is 25% on sale. I hope you remember the markup and margin. If you don't, make sure you revise that again. It's quite important area, markup and margin. So markup and margin is all about how you convert the value. Markup goes to cost of sales and margin is linked to the sales. So this question tell us margin 25. Now if this question don't give us the sales figure, we'll be in trouble. We have to convert the figure. But we can see the question give us the sales, so we don't have to worry because margin is linked to sales. But problem will happen when they will give you markup here and they'll give you sell. So markup and sales is contradictory, it's not going to each other. So you have to change the value that time. But this question is straightforward. Maybe in the exam it will be not. Then we have a hope inventory 1st of April. So 1st of April 2006. We are doing 31st of March 2007. So that's my opening inventory 5050. Purchase were recorded 48,390. So that's my purchase. All right, so let's have a look. Using this information, complete the following task. Calculate the cost of goods sold for the year ended. Calculate the cost of goods sold for the year ended 31st of March 2007. Then calculate the closing inventory. So how much is the closing inventory? So let's find our cost of cost of goods sold. Now, if they said profit on the sales, we can see on the sales is 64,900, and out of 64,900 sale, they are saying 25% is the profit. So if 25% is the profit, then 75% is the cost, isn't it? And that gives me 100%. Because if 25% is the profit, question said, that means 75% is the cost. So let's calculate the cost then. 64,900 times 75%. And that gives me 48,675. So that's my cost of goods sold, 48,675. Now the next question they're asking to calculate the closing inventory. To calculate that, we'll follow our cost of sales formula. If you remember that, opening inventory plus purchase less closing inventory. We said opening inventory plus purchase less closing inventory, and that will give us cost of sales, COS. So the opening inventory from the question 5050, the purchase from the question 48,390. The closing inventory you don't know. The question asking for that. The cost of sales you already know, 48. 48,675. So the one is missing, that is closing inventory. Now it's easy, but there's a tricky thing. So all you have to remember, when you try to find something and when you go from the bottom, from here, when you go up, bottom to up, so anything is a minus here, you make it plus, or anything is a plus, you make it minus. So when you come top to bottom, let's say for example I said 5050 plus 48,390 minus whatever it is, that gives me cost of sales, but we don't know how much is the closing inventory, one is missing. So if I go from the cost of sales to the closing inventory, so I need to do opposite. So I would say the opposite. So how do you do that? So let's say to find 47, so we can say 48 675. So this one we have a plus, so we can make this one minus 48,9390, and this is a plus, we can make it minus that 5050. And if you get the difference, how much it will be. Now if you do the way you like, Sifa, there is no problem. If you can understand this question, you can do the way you like, but as long as you have the right figure, there is no problem for that. 48390 minus 5050. So we have 4765. 4765. So you're going to write here 4765, and that is our minus. Now if we do that, this plus this minus this, that will give you the closing inventory. So when you go from bottom to up, you do the opposite. If something is plus, you do minus. If something is minus, you do plus. And you come from the top to bottom, you do normally. So this question, obviously the closing inventory is missing, you have to identify that, and that's how we can do that. So we'll say the closing inventory will be 47 and 65. All right, the next one we have here, say you compare this figure with the result of physical inventory count as a year end. The total physical inventory value is 350, lower than your calculation above. So they are saying when you're calculating physically, so that is less 350 less than here. So we have calculated the closing inventory 4765, and when I calculate physically, I found 350 is less. So the first question is asking which one of the following could explain this? What is the reason why it is less? Remember, if you count the inventory today and it is 500, and after 1 week when you come it is less 350, so you understand the owner of the business, he took it because it's a sole trader business, he owned the business by himself, so maybe he took his for his personal use. So all you need to remember, if the question said the physical inventory is less than whatever you have calculated before, the possible reason will be the owner of the business, he took some money, he took some physical inventory from there, and that is drawings. So because of the drawings, that could reduce the balance. So here they said the equipment, office equipment used in the office was stolen. We don't say this is stolen. There were unpaid sales invoice. No, a high value of inventory was counted twice. The trader has made some drawings of the good during the year. So basically, the traders, the owner of the business, he took some for his personal use. So the drawings, we always go for that. We don't go for a stolen. We don't go for a mistake. We don't go for a we counted twice. But the sole trader, so we believe maybe the owner he withdrew some physical inventory. And he said update the value of the closing inventory to account for the different above. So how much will be the value? We can see it 4765 minus 350. That will give us the new value 4415. 4415. That's it. Okay, the next one here we have said the trader has a policy of allowing customer to settle their account 1 month after the sales made. The trader has a policy, this is the company policy, to allow customer to settle their account 1 month after the sales has been made. So when I make a sales, I give them 1 month. So I said you can pay me after 1 month. Which of the following is most likely? So that means it's not gonna be absolute, it's not gonna be correct figure. Most likely. Because when I say like how much will be the sale for the next month, I can guess, I cannot say the exact figure. For example, based on my previous experience, based on the past record, I can say the sales will be between 10 to 12,000 or between 25 to 30,000. But I cannot say the sales will be 27,001 pound because it's not something I can guess very accurate. So the forecast or what will happen in the future, I cannot say exactly. I can only guess based on the previous record. So most likely means what you guess, what you believe, what will be the most likely to be the total of the sales ledger at the end of the financial year. So they're asking how much will be the sales ledger. Sales ledger. So sales ledger means the credit customer, and we allow them 1 month, isn't it? 1 month after sale. So our total sales was how much? 64,900. 64,900 was our total sale for the whole year. 64,900. That was the sale for whole year. And if I divide by 12, that will give me the sales for every month, average sales for every month. So 64,900, if we divide by 12, we'll get like how much is the sales for per month. So it's 5408. 5408. That is my monthly sale. If my yearly sale is 464,900, if I divide by 12, that gives me my monthly sale, that is 5408. Now, so 1 month is always due. So that means, let's say for the, if my year is January to December, that means the sales I make on December, I will get the money on January next year. So 1 month will be holding. So I'm not going to receive the last month sale on the same month. That will be to the next year. So 1 month sales will be roughly this 6408. Now from here, so this one will be sales ledger control, isn't it? That will be the outstanding, the customer going to pay the last month, credit customer. So that is our sales ledger control. Now from here, which one is closest? Most likely you think your sales ledger control will be for this year. So obviously you can see as we said like it will be an obsolete, but we understand even my sales is little bit increase, that will be 6940. That is the closest one. So my sales for this year is 5,400. Maybe it will be increased to 6,900, but it cannot be like 16, it cannot be like 64. So this is the most likely one, most likely. This type of question you need to be careful, because if you don't know the meaning of the most likely, maybe you will do a lot of calculation just to find it out the exact figure, and you are thinking it's not matching, and you spend a lot of time for 1 marks. So if the question said most likely, you are not looking for a absolute figure. Yes, Carmen, I can explain again. So basically the question is saying the company allow 1 month after the sales is made. So when I make a sales, I give 1 month credit to the customer, so customer can pay me after 1 month. So for the whole year, for the whole year, for the whole year, I make a sales 64,900. So 64,900, I make a sales for the whole year. So if I divide by 12, that gives me the sales for the monthly 5,400. 408. That's my monthly sale roughly. 1 month will be due because the last month the last month we make a sale from the business, they will pay me next year because they get 1 month credit. So if I make a sale on January, they will pay me February. If I make a sale on February, they will pay me on March. So after 1 month. So for the year January to December, whatever sales I make, I'll get everything except the December month, the sales I make, because I'll get it January the next year. So 1 month will be outstanding. And of course, if it is outstanding, we called it sales ledger control. The customer going to pay me in future. So only 1 month the customer will pay me in the future. So how much it will be? So based on my previous record is 5,408. But from the question they said how much will be most likely next year. So next year or this year, most likely it will be close to which one? So if my last year sales is 5,400, this year how much it will be? What is the closest one? So the closest one is 6940 because this is not close, this is not close. That's the only one is very close. But the reason what I was saying, Carmen, it is like maybe you was looking for like how I can get 6940 or 16 because you do a lot of calculation. Maybe you think you are wrong because when you divide it will give you 5000 and it is not matching and you feel like what is it? Maybe I'm doing something wrong. But if the question said something that is subjective or most likely the subjective figure, it's not absolute, it's not correct. So you have to guess something. What is the closest one? All right. So let's move on to the next one then. The next one says you are now working on the final account of another client. Your manager is called away unexpectedly. He asks you to undertake a particular task with a deadline during his absence. You know you have not received sufficient training for that. So basically, they're asking to do some work, but you don't have enough training for that. What should you do? So it says, do the job best your ability. Ask if you may have support from somewhere else in the organization. Ask your family member who is qualified to do work for you. Advise the client the deadline will be missed. So which one we think like? Because I don't have enough experience to do it. Of course, I will look for the support, but remember, not from outside. I will not ask someone from the family member. I'll ask someone from the organization. I said that one. So let's move on to the next one. Task 3 we have. Task 3 is said this task is about final account for a sole trader. You have the following information about event on 1st January 2007. A sole trader business is started. The business was not registered for VAT. The sole trader transferred 13,000 of his own money to the business bank account. So if a person transfer his own money to the business, so anything, not only the money, if you give anything, even this pen, if I give to my business, that will be added to my capital. So if a owner of the business, if he give anything to the business, that will be the capital. So if the owner of the business give any of his personal asset to the business, that will be the part of capital. So 13,000 is the capital. Then the next one is said 1100 was paid from this account for some office furniture. Remember, this is not the capital. The question is tricky because the question said from this account. From this account means business bank account. 1100 was paid from this account for some office furniture. That means from business bank account. So if business buy something by using the business bank account, then it is not basically the uh, capital because business will use the business money. So capital is only that is given by the owner of the business from his personal asset. So 1100 is not the capital because business using business account. 900 of goods for resale was purchased. The supplier allowed 1 month of credit. So basically, this is the sale from the company. There is no relationship with the capital. 900 of goods for resale or purchase, so it's a credit purchase. The supplier allowed 1 month credit, so that's fine. So when you buy something from the supplier, we have 1 month to pay the money to the supplier. What is the requirement? They're asking to complete the capital account and showing the balance CD. Balance carried down means balance CD. And the next one it says that's a different one, so you don't have to worry about that. This question only relevant with that. So let's do that. So which one is the capital here? That's the capital from his own money. 1100 paid from this account. No, that's not the capital. From the business account, if I buy, it's not a capital, so it's not capital. This is a purchase, so this is not a capital as well. So I will say capital is normally is a credit item. It's a liability from the business point of view because business have to pay back this money to the owner. So capital is normally is a liability. So he said the opening balance for the capital. And where did you give that this money? So you give to the bank. Bank 13,000. The total is 13,000, and the balance ready is 13,000. That's a very simple question. It's all right, Magda. So this is basically the easy question. You can see it's nothing to worry about it. But when you read the question, read a little bit carefully so that you understand. Like this 1100 is not the capital. Let's read the next one. It said you are now working on the final account of a sole trader, Onyx Trading. You are to prepare the statement of financial position for Onyx Trading as at 31st March 2007. The final trial balance is below. A profit for the year ended 42,495 has been recorded. That's the profit. Okay. Oxen has a policy of showing trade receivables net of any allowance for the doubtful debt. So if we have any doubtful debt, we have to minus it because company policy like minus the allowance for doubtful debt from the trade receivables. Trade receivables means sales ledger control. Trade receivables and the sales ledger control is the same thing. Using the information, complete the task, calculate the value of trade receivables that will be appear in the financial statement. The question already said how much will be short. So from the sales ledger control, we need to minus the allowance for doubtful debt. Whatever it is, it going to come here. The next one, they're asking to prepare the financial statement. That's it. Okay, so it's for the sole trader. So we understand it's not difficult. So let's do that. Let's do the first one. So let's have a look. How much is the sales ledger control we have? So we have 25,660. This is my sales ledger control balance. And the question said minus any allowance for doubtful debt. So you can see allowance for doubtful debt, we have 1,200. So you have to minus that because the company have a policy to show it is the net value of the receivables. So we said that will be 25,660 minus 1,200, and that will give you 24,460. So I said 24,460. That's it. Remember this profit figure 42,495 because when we'll do our capital section, we need this figure. Let's move on. Again, we'll do it on the corner so that we can see the question and you can do the answer as well. So first we start with our non-current asset, NCA, non-current asset. In the non-current asset, we have three things. Remember the cost, then accumulated depreciation, and we have carrying value. Sometimes some question might say book value. Remember the carrying value and the book value is the same thing. So the cost is 32,000, and we have equipment. So that's the only asset we have, I think. Equipment cost 32,800. So equipment 32,800, and the accumulated depreciation for that is 40,350, 14,350. So from cost, if I minus the accumulated depreciation, the remaining value is called carrying value. That will be our 18,450, 18,450. So right now, the value of the non-current asset is 18,450 because accumulated depreciation means this value is already gone. Why? Because the asset may be really old and some of the value is already gone. So right now, the carrying value is 18,450. Remember, carrying value is not the market value. We are assuming the value right now we have with this asset, that is 18,450. But in the market, we might sell it more and we might sell it less. That will be the question for the disposal. So if we can sell it more than the carrying value, that will be the gain that comes to the profit and loss account. If we can sell less than the carrying value, that will be the loss that will come to the debit side of the profit and loss account. So that's the only non-current asset we have. Then we move to the current asset, CA. CA means current asset. On the current asset section, normally we have inventory, trade receivables, prepayment, your bank, cash, this type of thing. So let's try to find what we have. So we can see we have the prepayment. Prepayment is an asset. So we said prepayment, 900. And then we have closing inventory here. So let's have a look. Where is the closing inventory? 22.4. So closing inventory 22,420. What else we have? We have a bank. Remember, you only take the bank if it is on the debit side. If the bank is on the credit side, that will be your current liability, and do not take that. So bank has to be on the debit side to take on the current asset section. If bank is on the credit side, do not take the bank. 1645. And what else you have? Trade receivables or sales ledger control. That is, we already calculated 24,000 here, but we're not going to take that. We already calculated that before. 24,460. 24,460. Now we have to add all the current asset. So added all of this. If we added all of this, that will give you the total of the current asset. So let's find that, how much it is. 49,425. Thank you, Sifa. And after that, we move to the next section, that is CL, current liability. On the current liability section, you have to see how many current liability you have. The first one you can see here, accruals. This is a current liability. Accruals means we use the services, but we didn't make the payment yet. I'm sure all of you know it from our bookkeeping, advanced bookkeeping paper, accruals. So that is 1940. Then after the accruals, we have trade payable, that is purchase ledger control. Purchase ledger control, 16,720. Then we have payroll liabilities. Payroll liabilities, 630. And we have VAT on the credit side. That is also our liability. So the current liability is the liability that we have to pay within 1 year. VAT. So any liability that we have to pay within 1 year, this is our current liability. Now we'll add all of this, and that is 3,180. Thank you, Sifa. So if we added all of this, that will give you that. And now we'll find the net current asset. Net current asset means the current asset minus current liability. So this one and minus this one. So if I minus the current liability from the current asset, that will give me net current asset. So net current asset, and that is how much? 26 to 45. 26 to 45. And if I add it with my fixed asset or non-current asset that we have calculated in the top, if we added this to net current asset plus the non-current asset, that will give you the net asset. Net asset. This template has to be on your head. You don't have to follow even the steps like non-current asset, current asset. It's just a few things. If you do a few times, that will be on your head, like what comes under non-current asset, what comes under the current asset, what it is. This template has to be on your head. So the net asset, we have how much it is, 44,6. So 44,695. Very well done. So our one section is done. So we done one side, net asset. Once you have the net asset, that means one section is done. Now we have to move the next section. The next section is basically finance by section. Finance by. On the finance by section, we have a formula that is opening capital plus profit less drawings, and that will give us the closing capital. So let's have a look. How much is the opening capital? Do you have any capital here? That is yes, 22,200. 22,200. And the profit is 42,495. Thank you, Sifa. So 42,495. And the drawings. Is there any drawings you have in the question? Yeah, 20,000. So minus 20,000. The drawings. And now the figure we have, that should exactly match to our net asset. So that is 44,695. So remember, this figure and this figure has to be matched, because the statement of financial position, the debit side and the credit side has to be matched. So asset and liability should be equal to the finance by section. If this two section doesn't match, that means there is some mistake maybe we have done during the question. So if this section doesn't match, you can always check again. But this section has to be matched when you complete your statement of financial position. All right. So is there any question from here before we move to the next question? All right. It's sometimes this type of question looks a little bit long, but it's not difficult, to be honest. Shehzad, you asking, please, can you explain net current asset and the net asset? Okay, I can, of course. So the net current asset, if you can write it down, net current asset is basically current asset minus current liability. This is basically net current asset. And the net asset equal non-current asset plus net current asset. If you added this two, that will give you the net asset. Yeah, so for the time being, if you know the formula, that will be more than enough to help you to do the calculation. All right, so let's move on to our next section. In the exam, you have the template like this. All you need to do is to select. Remember, they might give you more. Under the net current asset, you can see 1, 2, 3, 4, 5, but we have used only 4. You might not need all of this drop down, so don't just think like I have to use all of this. Maybe you don't have to. Okay, the next section is asking, complete the following. Drawing for the year will be transferred as a what? Debit or credit to the capital account in the general ledger. Drawings, remember, drawings always reduce your capital. Drawings means if you take anything from the business for your personal use. So if you take something from the business for your personal purpose, that always reduce your capital. So capital is normally credit. So if you want to reduce the capital, you make the capital debit. So you're writing on the debit side. So drawings will be always debit on the capital section. An opening balance of the capital account. How much was the net asset? We have calculated 44 695. Yeah, that's the one we have calculated, the closing capital. All right, so let's move on. Let's move on to the next one. Task 4 says this task is about knowledge and understanding of underpinning the final account preparation. Complete the following statement. Which one of the list is a benefit of running a business as a sole trader? So from here, which one you think is a benefit of running as a sole trader? We already know sole trader is a business who run by one person who have a greater control. He can do anything what he like. So this is the main advantage, isn't it? So we can say complete control over the business decision. This one is a disadvantage as out unlimited liability. It's not advantage. It's a bad for him, isn't it? It cannot be the benefit for him. The benefit here, like he can take the decision immediately, and he have a control over the business. So it's not the unlimited liability. That cannot be advantage or benefit for him. The next one we have complete the sentence. A private limited company is owned by whom? Company owned by whom? Directors, shareholders, or the trustee? Remember, even sometimes we think that directors are the owner of the business. Director can be or cannot be owner of the business. The main owner of the business is a shareholder. Remember that. The main owner of the business is the shareholder. Director can be, cannot be. Director are the mainly employee. Director are the people who run the business. Director are the people who direct the business. For example, if someone drive a bus, maybe he is the owner of the bus, or maybe he is not owner of the bus. But he driving the bus, he giving the instruction, he taking the bus somewhere. So he is the director. So the driver of the bus will be the director, but doesn't mean who is driving, he is the owner of the car. He is the owner of the bus. He can be, he cannot be. So that will be the shareholder. And it says which of the following business have owner with limited liability for his debt? Which of the following businesses have owner with limited liability for his debt? So Joe and Joseph partnership, Joe and Joseph uh, LLP, and the Joe Blogger PLC. So we know the partnership have a two from. One is like normal partnership, that one have an unlimited liability. But another one we have a limited liability partnership, that is LLP, and PLC is a public limited company or private limited, whatever it is. Remember that LC is the limited liability. So LLP is a limited liability partnership. So that will be 2 and 3. So in partnership, we have a two form. The partnership can be limited, can be unlimited, both. Let's move on to the next one. Complete the following sentence. It said the charity organization must be satisfied the definition of a charity found in where Charity Act or of the Code of Practice for the Non-Profit Organization. So charity will be run following the Charity Act. Charity Charity Act. Then we have the next one. Which one of the item below prescribes the format of final account preparation for the organization IFRS? So which one basically following to present the financial statement? So when you present the financial statement, we said revenue, then we minus the cost of sales, then we minus the operating expenses, then we have the profit. So this template, this format, who introduced this format? What IS we followed? That will be IS1. Remember that. IS1 is presentation of financial statement. IS1 is the presentation of the financial statement. IS2 is the inventory valuation. So obviously this is the IS is the guideline how to basically follow all these rules and everything. So all the accountant that prepare the accounts and everything, they follow the all ISs. So let's move on. The next one, number C. This one says link the box to match the following users of a final account with the most likely reason for the interest. Make each section by clicking on a box in the left column, then on the right column. You can remove a line by clicking on the line. So user, management, and the reason, shareholder, and the reason why they need to use the financial statement. The first reason, management, why they have to use the financial statement. So you have few reason: access of the security of the loan, security of the loan, decision making relevant to their personal investment, to compare the information from the organization operating within the same business sector, to assess future performance of the business. Remember, the management main responsibility to the compare. So comparison of the internal data, comparison with this year with the last year, comparison with our data with the industry data. So comparison is the main job of the management accountant. So this is the reason they want to see the financial statement. So we said to compare. Shareholder, why you think the shareholder need to look at the financial statement? So shareholder need to see, like, should I invest to this company or not, isn't it? So they have to take the decision. So shareholder decision making relating to their personal investment. So for example, if Magda decided to invest today to Tesco, so before she invests to Tesco, she will open the financial statement of Tesco and we'll have a look what's going on there. So what is the investment return, what is the dividend rate, what is the financial position, and after looking at that she will decide should I invest or not. All right, so let's move on to the next one. The next one we have, this task is about accounting for the partnership. Says which one of the following should be included in a partnership agreement: partnership appropriation account, salaries and wages to be paid to all employees, the rate at which interest is to be allowed on capital. So which one you think should be on the partnership agreement? So remember that if you take interest on capital, it is not very common because partner give the money to the business to run the business. But sometime the business said whatever the partner said whatever investment we'll make in the business, will take some interest on that. So if the partners decided to take some interest on capital, then you have to include that on the partnership agreement. So we said yes, we have to include that on the partnership agreement. So that will be our answer. All right, let's move on to the next one. The next one we have here, that is for the partnership question. Says Ariba, Sam, and Terry has been its owner for many years. Okay, so on 31st of March 2007, Rivat retired from the partnership. So it was three partner before. Now Riva is retiring, so it will be two partners. Goodwill was valued 52,000, has not yet been entered in the accounting records. So goodwill has been valued but not recorded yet. The profit sharing ratio, Riva Sam Terry. So when it was three partner, it was 50, 40, and 10. So this is the old profit ratio. Now, after the retirement, only Sam and Terry is left. So now the profit ratio is 70 and 30. Goodwill is to be introduced in the accounting record on 31st of March 2007. So on 31st of March, we'll introduce the goodwill with the partnership change and then immediately eliminate. So obviously the question said record the goodwill on 31st of March, then after that eliminate it. So that's fine. We already know that how to do it. So basically when you record the goodwill, we use the old profit ratio, and when you eliminate the goodwill, we remove with the new profit ratio. So let's have a look. What was the goodwill here? So with the old profit ratio, we can say that is a river. So record goodwill is record goodwill. When you record the goodwill, remember the goodwill will be debit and the capital will be credit. So I said goodwill debit 52,000 and River, Sam and Terry all capital will be increased by the amount of the old ratio, that is 50%, 40% and 10%, and that will be how much? 26,000. Okay, 26,000 for Riva, then for Sam 20,800 and Terry 5,200. There's a recording, and after that the question said then eliminate immediately. So I need to eliminate that. So when you eliminate the goodwill, so it said eliminate goodwill. This time goodwill will be credit and the capital account will be debit, but with a new ratio. Now the new ratio we have only Sam and Terry. So Sam capital account 70%, Terry capital 30%, and that is 36,400 for Sam. For Terry 15,600. That's all. So this is basically when you record with the old ratio, elimination with the new ratio. That's it. And all you have to do, you have to record this journal in our, so goodwill will be credit. Goodwill credit 52,000. Okay, let's do the first one, recording. So goodwill is a debit. So on the debit side, I'm going to write all of these three because it's a debit. So goodwill is a debit. It's a goodwill account. On the debit side, I'm going to write River, Sam, and Terry. So I'll say 26,000, then 20,800, and 5,200. So this is our 52,000. And now goodwill is a credit. So on the credit side, when I eliminate, I have Sam and Terry, 36,400 and 15,600. That is also 52,000. And the goodwill account have no balance CD because both are equal, no balance. So that's how we have to record the goodwill and eliminate the goodwill. If you can remember the journal, the debit and credit, your life will be easy. So I would say like always remember the journal, recording the goodwill will be debit, and when you eliminate the goodwill will be credit, and it will be increasing the capital when you record, it will be decreasing the capital when you eliminate. All right, let's move on to the next one. The next one is saying You have the following information about another partnership business. The partner are Asma and Ben. The financial year ended 31st of December. There is no interest on capital or drawing. Figure relating to the year ended 31st December 2007 were as follows. Profit share Asma 60%, Ben is 40%. Salary per month. So that means we have to multiply by 12. So 1950 for Asma and 1400 for Ben. Commission during the year 4500 for Asma, 8300 for Ben. Drawings 28,000 over the year and 2000 each month. So remember, obviously, like which information go to where. Remember, drawings is not relevant to your appropriation account. Profit for the year 80,000 before the appropriation. Prepare the appropriation account. So this is the appropriation account. We know how to do it. So we need to remember like which information come here, and remember we don't take the drawings for the appropriation account. Let's do it in the corner. It's not very difficult, I think. So let's start with that. Start with profit before appropriation. Profit before appropriation. So profit before appropriation is 80,000, and from here we minus all these expenses. If there is interest on drawings, we add. Other than we minus everything. So the first thing we'll do salary. Salary. So we have a two-person Asma and Ben. So salary for Asma, how much it is? 23,400. Okay, 23,400. And for the Ben, 16,800. All I did, we multiply with the 12 because it's per month. So you have to know for the whole year. So per month is 1950. If we multiply by 12, that will give you for the whole year. Then you have a sales commission. Sales commission. So for Asma is 4,500. And for Ben, Asma and Ben, that is how much? 8,300. We minus everything because we're paying everything from the profit. And after that, anything left, you call it residual profit. RESIDUL, residual profit. How much is the residual profit? 27,000. 27,000. And from this 27,000, we have two-person, Asma and Ben. So Asma is 60%, Ben is 40%. So how much is the 60%? We have Asma, that is 16,200. And for the Ben, how much it is? 10,800. If I added this two, it should be 27. That's appropriation account. So it's really simple. All you need to remember, even the question give you drawings, so you don't have to take it because the drawings belongs to the current account, not here. All right, so we have a task 6. That will be our next question. I think it's from the partnership as well. So let's have a look this question. So this task is about final account preparation for a partnership and introducing to reporting regulation for a limited company. You are preparing the statement of profit and loss for Onyx Partnership for the year ended 31st of March 2007. The partners are John and Pat, who share profit equally, so 50-50. This is their only entitlement to the profit. You have the final trial balance below. All the necessary year-end adjustments have been made except for the transfer of profit or loss to the current account partnership. So only the profit and loss is not transferred yet. Other thing, everything is done. So this is my partnership trial balance. Okay. And all you need to do, you need to prepare the profit and loss account. So that's all right. So you need to calculate the profit and loss account. I know what item is relevant to the profit and loss account. You already know that, like sales revenue minus cost of sales and operating expenses, and whatever is the profit, that will be the profit. So that's it. It's not very difficult. So what we'll do that. Let's take a break. Let's take a 15-minute break. We'll come back 11:45, and we'll start from this question number 6. I'll see you in 15 minutes time. So we'll start like around 11:45. So in this question, as I said, like the allowance for doubtful debt and the allowance for doubtful debt adjustment. So allowance for doubtful debt is relevant to SOFP, statement of financial position. But on the other hand, allowance for doubtful debt adjustment, that is basically SPL, statement of profit and loss account. So when you see the word adjustment, you need to understand this is the adjustment for the profit and loss account. And if it is on the credit side, that will increase your income. So increase your income. So that will be added with your sales. And if it is a debit side, so you have to show as expense, that will be on the debit side. Okay, so let's have a look this question and try to solve it together. Start with the first one, sales. Sales or revenue. I don't know what they're saying here. So sales revenue. So let's have a look. How much is the sales revenue? 25,54,480. Okay. 25,54,480. So this is our sales. From the sales, we need to minus the cost of sales. So less cost of sales, and the cost of sales is opening inventory plus purchase and the less closing inventory. So opening inventory plus purchase less closing inventory. So let's have a look how much we have the opening inventory and the closing inventory from this question. So the opening inventory we have 24,500. 24,500. Purchase, how much is the purchase we have here? 153. 153,070. And the closing inventory, that is 25,100, isn't it? That's the minus. And that will give us cost of sales. So how much is the cost of goods sold or cost of sales? That is 153. Purchase 153,670. Okay. So let me change this one then. 153,670. Some information we have on bill as well, so might need to see it if we need to. So we have the cost of sales. How much is the cost of sales? 153,070. Okay, so 153,070. If we minus it from that one, that will give us gross profit, GP, gross profit. So how much is the gross profit we have? 102,410. And after the gross profit, we need to add if there is any disposal or any allowance for doubtful debt adjustment. So you don't have any disposal, so only you're going to add allowance for doubtful debt adjustment 600. All right, now we need to minus all these operating expenses. So less operating expenses, and let's start with that. So the first one we have depreciation. Okay, Magda, so I'm following you. Depreciation, you said 9,700. Then loan interest, that is 168. Office expense, 31,630. Payroll expense, 16,950. Selling expense, 105.42, and the total is 68,990. 68,990. Very good. And if I minus it from this two, that will give me the net profit. So profit, so 34,020. Okay, that's my profit. That's quite simple question. It's not difficult at all. The only trick here, the allowance for doubtful debt adjustment, that's it. Other than everything is quite simple. All right, so let's move on. All you need to do on the template, you have to follow all of this. So sales revenue, write it down here. Then opening inventory, closing inventory. So you just follow the template. The reason we're writing in the corner because we cannot see everything at the same time. All right, let's move on to the next question. The next one is saying calculate John's share of profit or loss for the year and his final current account balance. So they're getting half off, isn't it? So let's get it done. And the John current account balance. So how much the current account balance John have already? So current account John. So John already have a current account balance 780. So that will be added with the profit. So let's say how much is the profit? He will get half of the profit, 34,020. If I make a half, that will be 17,010, and the current account balance will be added plus 780. That will give us the current account total balance. So the new balance will be 17,790. So if he make any profit, obviously that will be added the new balance. So his new current account final balance will be 17,790. This one is the share of profit. The profit was 50-50. That's why he get half of the profit. We make 34,020. And this one, the current account balance added 780 because he already have some balance on the credit. If it is a debit balance, we have to minus that. Remember that. As it is a credit balance, we added. If it is a debit balance, we minus that. And the next one we have, where will the current account balance for John will be appear in the statement of financial position for Oxen? So it is basically the partnership, and that will be shown. The current account balance will be showing on the finance by section. Remember that both current and capital, both for the partnership, the finance by section is the combination of current account and capital account. So this is a combination. Current account and the capital account total is basically the finance by section. So both current and capital, both balance come to under the finance by section. Okay, let's move to the next one. The next one is asking preparation of the final account for a limited company as its year-end required for the more detailed reporting than a sole trader partnership. Okay, which of the following statements are true for a limited company? Which of the following statements are true for a limited company? A taxation charge should be shown in the statement of profit and loss account. Yes, it is true. In the limited company, we show how much is the tax. We show it on the statement of financial position. A full analysis of non-current asset must be appeared on the face-to-face statement of financial position. No, that's not true. That's false. Because we just said this is the cost, this is the accumulated depreciation, and this is the carrying value. We don't show the breakdown. So we don't show the full analysis, how we end up with this figure. We just give the total accumulated depreciation. We show the total value of the non-current asset and the carrying value, but we don't give the breakdown or analysis of that. That's false. Notes to the financial statement are available to third parties. This is true. Anyone can read it. And basically, this is for the people. The notes to the financial statement is like to make their life easy, who is not from the accounting background. The notes to the financial statement help them to understand the meaning of some accounting terms. For example, depreciation. For example, what is the trade receivables, what does that mean, the dividend. So this type of technical word maybe the non-accounting people will not understand, so that's why they read the notes to the account. So this is the meaning of that word. So what is basically saying by by telling this information. So if you see any word that is not very easy or complicated, so this is the explanation we can see on the notes to the account. So that is also true, and anyone can see that. So that will be 1 and 3, isn't it? Okay, so I think that's it. We have the question. In the exam, you will see the 6th question as well. So it's not like too many questions you will see. And you see like this course is not very tricky like the advanced bookkeeping or management accounting. So I would say like it is enough for you to make yourself ready in a week for the exam. Even you can do this exam next Saturday if you want to. You can book yourself. Obviously, going to receive the email from the admin team. They'll tell you like how to book. So you need to book the exam. And once you book, we can see like next Saturday I can set up the exam for all of you. So I would say like next module we're going to start indirect tax, Magda, because we done that management accounting, isn't it already? We done management accounting, we done advanced bookkeeping, we have done now final account preparation, and we will do the next one, we'll do indirect tax. And hopefully by the time we'll do the indirect tax, then we can start with maybe in the class, and then we can do our what's that called, uh, the Excel and the ethics, and we can get ready for the synoptic. You can do it, Carmen. There is no problem. It is a